What if I told you there's a bond that could double your money without paying a regular interest payment? Let's dive into the fascinating world of zero coupon bonds. Unlike traditional bonds that pay regular interest, zero coupon bonds are sold at a deep discount to their face value and pay no interest until maturity. It's like buying a $100 bill for $70 today and getting the full $100 in the future. But why would anyone want a bond that doesn't pay interest on a regular basis? Well, that's where things get interesting. Zero coupon bonds offer a powerful growth alternative to traditional income-focused bonds. They're the secret weapon in many savvy investors' portfolios. If you're new to bonds in general, check out our video on bond basics for a quick primer. Now let's explore 5 strategies where zero coupon bonds shine. First, college savings. Zero coupon bonds are perfect for planning for future expenses or any kind of cash needs far off into the future. Buy a bond today that matures when your child starts college, and you've locked in the exact amount you'll need. Stagger them over the 4 or 5 years you expect them to be in college, and you'll have cash on hand each semester when that bill arrives. Or do this in a combination with index fund investing and a 529 plan to capture better returns in equities, but leaving you with the certainty of those bonds coming due when tuition is due and not having to sell those index funds in a possibly down market if you don't want. Next up, they can be used in retirement planning. Use these bonds to create a ladder of maturities that align with your future cash flow needs in retirement. Perhaps you only want to take out your required minimum distributions, or RMD, each year from your IRA. Build a ladder of zero coupon bonds that will come due each year, just in time for you to take your RMD each year. This way your money continues to grow, but you won't have to worry about reinvesting interest payments, huge market fluctuations in stocks, or any of the other uncertainties we try to plan for when investing. Next, we'll discuss using zero coupon bonds in saving up for a down payment on a house. Let's say you're hoping to buy a house in 5 years and you've begun saving for a down payment. Why not put that money to work between now and when you're ready to buy that house? You could invest in an S&P index fund to try to maximize your return. But what about those stretches where the stocks just don't perform? You certainly don't want 5 years to turn into 10 because the stock market just so happens to be going through a rough patch just as you approach 5 years. You can lock in savings by purchasing a high-grade corporate zero-coupon bond or a U.S. government agency zero-coupon bond. Both have really low default risk but solid returns, so your money will work for you while you wait. Next, what if you think interest rates are going to really decline over the next few years? What's the best investment for maximizing your returns? The answer is long U.S. Treasury strips. We go into some of the different types of strategies in the video on your screen now, and I'll be sure to put it in the end screen so you can finish watching this one all the way to the end. The key takeaway on this strategy is that zero coupon bonds appreciate the most when interest rates decline. That also means they suffer the greatest losses when interest rates rise, so be cautious. Lastly, just like in the college tuition example we discussed earlier, what if you'd like to have a chunk of cash available around the time you're expecting to retire? Buy some zero coupon bonds that will come due around then. It could be nice to have a chunk of money available to help you bridge the gap between when your pension or your Social Securities payments start to kick in, or to invest in something that could generate some additional income for you in retirement. In the end, it's just nice to know you'll have a chunk of cash available when you retire, no matter what the market does between now and then. Keep in mind that there are different types of zero coupon bonds which will allow you to diversify some of your risk. We have Treasury strips, U.S. government agency zeros, municipal zeros, Treasury bills, and even corporate zero coupon bonds. Each has its own risks and tax implications. Speaking of taxes, here's a quirk that might surprise you. Even though you don't receive cash interest payments, the IRS considers you to be earning phantom income each year. Don't worry, I'll explain how to handle this in a moment. Here's a bonus tip. Zero coupon bonds can be a fantastic tool for estate planning. By purchasing long zero coupon bonds and gifting them to heirs, you can transfer significant wealth while minimizing taxes and allowing your money to grow beyond the gift you give. For example, today you could buy a 15-year U.S. government agency bond at around 47 cents on the dollar. That means you could gift around $15,000 worth of Tennessee Valley Authority bonds, and in 15 years, they'd be worth $31,000. If you wanted to wait longer, let's say 28 years, for that bond to come due, you could purchase $15,000 worth of bonds at a little over 25 cents on the dollar, and they'd be worth about $57,000 when they mature. That's a heck of a gift, and you could do that every year. If you're finding this information helpful, don't forget to hit that like button and subscribe. It helps the algorithm, and let's face it, the algorithm needs all it can to help it understand bonds. Here's a strategy I use in my own investing. I pair zero coupon bonds with much higher coupons that are priced at premiums of 110 or even higher. The premium bonds provide current income, while the zeros provide guaranteed future value. It's a great way to create a synthetic par bond. Higher coupon payments today and return of principal tomorrow. Now let's address some common misconceptions about zero coupon bonds. 1. They're risk-free. While Treasury zeros are backed by the government, all bonds, including zeros, carry some default risk. Also, keep in mind, as I mentioned earlier, they are more impacted by interest moves than coupon bonds. However, if you're planning on holding them until maturity, that market risk doesn't matter. No matter whether the market is up or down from when you bought them, they'll still mature at the same face value amount. 2. They're only for big investors. Not so. You can start with less than $1,000 in some cases, and the added bonus is those smaller amounts become larger amounts when they mature. 3. They're too complicated. With a little education, like this video, anyone can understand and use them effectively. They're actually quite simple. Here's a pro tip from my 30 plus years of bond trading, which includes trading Treasury zeros and Muni zeros. The annual growth you see in your zero coupon bonds each year as they approach their face value at maturity is called interest accretion. One important fact, each year your tax forms from your brokerage firm will show you the amount of interest accretion for that year. However, for tax-exempt municipal zero coupon bonds, you don't have to pay any taxes to the federal government. And if the bonds are tax-exempt in your state, you won't pay state taxes on the accretion either. Zero coupon bonds offer a unique opportunity for growth in your fixed income portfolio. They're not just about avoiding the hassle of reinvesting interest payments, they're about locking in future values today. Ready to learn more about zero coupon bond investing? Check out our video on how to invest when the Federal Reserve is cutting rates, where we go into the details on how you can use zero coupon bonds to realize some pretty nice returns when interest rates are declining. Remember, always consult with a qualified financial professional before making investment decisions. Your financial situation is unique, and what works for one investor might not work for another. Please see the description for the full disclaimer. Please tell me I hit record. Yes, I did.